You're paying more, you just don't see it. The price tag didn't jump. There was no dramatic increase, no obvious warning, but the box feels lighter, the service feels thinner, the basic version feels incomplete, and slowly, without noticing the exact moment your cost of living rises. Companies don't always raise prices directly. Sometimes they redesign them, and redesign is harder to resist than a visible increase. Most people think inflation is a number problem. If something moves from $5 to $7, that's inflation. But modern pricing is subtler. If something stays $5 but becomes smaller, or cheaper to produce, or bundled differently, the number didn't move. So psychologically, the price didn't change. That illusion is powerful. Because humans react to numbers, they adapt to structure. Businesses know this. So instead of raising the number, they adjust the structure. Shrinkflation is the simplest example. A cereal box looks identical but weighs less. A snack bag feels the same but contains fewer pieces. A bottle becomes narrower. A container slightly shallower. The shelf price remains unchanged, but the cost per gram increases. Most shoppers don't calculate unit pricing in real time. They recognize brands. They remember approximate prices. They move quickly, so reducing quantity by 8 to 12% often creates less opposition than raising price by 8 to 12%. It's not hidden, it's tolerated. The second method is even quieter. Instead of shrinking size, companies reduce cost inputs. Ingredients change, materials downgrade, durability shortens. The product looks identical, the packaging stays familiar, but the margin improves. In services, this appears differently. Hotels reduce cleaning frequency. Airlines unbundle luggage and seat selection. Software platforms introduce ads or move features into premium tiers. The base number remains visible, but the full experience costs more. Instead of one visible increase, cost is fragmented. When companies can't reduce size or quality, they move costs elsewhere. Shipping charges appear. Convenience charges are added. Service charges become separate line items. Instead of increasing the product price, the checkout total increases. This method shifts responsibility. The base price appears stable, but the final cost rises. Psychologically, customers blame charges less than price increases. Because charges feel temporary, price increases feel permanent. So companies fragment cost instead of raising it directly. Subscription businesses perfected this strategy. A platform launches with one simple plan. Over time, ads are introduced. Premium tiers appear. Core features move upward. Bundles replace simplicity. The original plan still exists, but feels limited. So customers upgrade. Revenue increases without an obvious price hike. The number stays familiar. The value shifts. Pricing isn't random. Large companies have teams dedicated to it. They analyze consumer tolerance thresholds, purchase frequency, elasticity models, margin sensitivity. Before any structural change, they simulate backlash. How many customers leave? How many absorb it? How much profit improves? In many cases, a subtle redesign produces less friction than a visible price jump. So redesign becomes standard practice, not deception. Optimization. Modern companies don't guess pricing changes. They test them. Online retailers run A/B pricing experiments. Different users see slightly different offers. Some see bundles. Some see promotions. Some see higher base prices. Companies measure who buys anyway, who hesitates, who leaves. Pricing becomes dynamic, not fixed. And once data shows tolerance, the new structure becomes permanent. Inflation doesn't always come from rising costs. Sometimes it comes from discovering how much customers will accept. Public companies must show revenue growth, quarter after quarter. If costs rise, wages, logistics, energy, financing margins shrink. Shrinking margins lower stock value. Lower stock value increases pressure. So executives avoid visible price shocks. They choose gradual expansion instead. Because steady growth is rewarded, sudden disruption is punished. Once one company successfully restructures pricing, others follow. If airlines unbundle charges without losing passengers, the model spreads. If streaming platforms introduce ads without mass cancellations, competitors adopt similar tiers. No company wants to be first, but once pushback proves manageable, redesign becomes industry standard. And because it spreads, it feels normal. When inflation becomes normal, companies pre-adjust. They anticipate rising costs. They price in future increases early. Suppliers renegotiate contracts ahead of time. Landlords renew leases anticipating next year's expenses. Manufacturers build buffers into margins. So even when inflation slows, prices don't reverse. Because pricing already moved ahead, expectations themselves create persistence. People sense prices rising, but struggle to pinpoint how. The sticker price looks similar. The packaging looks familiar. The service appears unchanged. But over months and years, the structure shifts. The increase is real, just redistributed. That confusion reduces outrage, and reduced outrage sustains pricing power. Modern economies depend on revenue growth. Businesses borrow. They invest. They forecast expansion. Flat revenue destabilizes projections. So incremental price expansion becomes routine, not dramatic, gradual. Over time, gradual adjustments compound, and what feels like stability is actually steady drift upward. In theory, competition should push prices back down, but in reality, once a higher price level is accepted, companies hesitate to lower it. Lower prices signal weakness. Lower margins reduce investor confidence. Lower revenue affects valuation. So instead of reversing, companies introduce discounts, limited time offers, or loyalty perks. The official price remains elevated. Reversal becomes rare. Adjustment becomes permanent. People rarely boycott subtle increases because no single change feels dramatic. A cereal box slightly lighter, a subscription slightly adjusted, a fee slightly introduced. Each one feels manageable, but cumulatively, they reshape spending patterns, and consumers adapt faster than they resist. Habits matter more than price sensitivity. If you're used to buying a brand, small structural changes don't interrupt behavior. Companies rely on inertia. Inertia is more powerful than loyalty, and in a slow inflationary environment, inertia protects pricing power. People think price increases happen at the shelf, but a lot of the inflation you feel happens through defaults. The standard option quietly becomes the premium option. The cheaper tier stays on the menu, but it's harder to find, less usable, or missing the features you actually need. That's not an accident. It's how companies move customers upward without announcing a price hike. And once a higher tier becomes normal, it stops feeling like an upgrade and starts feeling like the baseline. That's why prices don't just rise, they stick. Because what gets normalized isn't the number, it's the new expectation. Companies don't always raise prices. Sometimes they raise everything else. The size, the quality, the tiers, the expectations. And because redesign feels softer than a number increase, it spreads quietly. Modern pricing doesn't shock, it adjusts. And in an inflationary world, adjustment is the strategy that survives.